Every year, millions of Americans turn down raises, not because they do not want more money, not because they do not need it, because they genuinely believe that earning more will push them into a higher tax bracket, and that higher bracket will somehow cause them to take home less money than they currently do. This belief is one of the most widespread financial myths in America, and it is completely, entirely, 100% wrong. The confusion comes from a fundamental misunderstanding of how the American tax system actually works, and that misunderstanding, held by tens of millions of people, including many who consider themselves financially informed, costs people raises, costs them promotions, and leads to genuinely terrible financial decisions year after year. Today, I'm going to explain exactly how income taxes work in America, the marginal tax system, what brackets actually mean and what they do not mean, how to calculate what you actually owe, what deductions and credits do and how they differ, and the specific strategies that legally reduce your tax bill, the ones that are available to ordinary Americans, not just people with accountants and offshore accounts. By the end of this video, you are going to understand your paycheck, your tax return, and your tax strategy in a way that most Americans never do. And that understanding is going to save you money, potentially a significant amount of it every single year. Stay with me. Let us start at the foundation. The American federal income tax system is what is called a progressive marginal tax system. Progressive means that higher income is taxed at higher rates. Not all of your income at a higher rate, only the portion that falls within each bracket. Marginal means that each tax rate applies only to the income within that specific bracket range, not to your total income. This distinction is the one that most people get wrong, and getting it wrong is where the raise-refusal myth is born. Here is how it actually works. For the 2024 tax year, the federal income tax brackets for a single filer are approximately as follows. The first $11,600 of taxable income is taxed at 10%. Income from $11,600 to $47,150 is taxed at 12%. Income from $47,150 to $100,525 is taxed at 22%. Income from $100,525 to $191,950 is taxed at 24%. Income from $191,950 to $243,725 is taxed at 32%. Income from $243,725 to $609,350 is taxed at 35%. Income above $609,350 is taxed at 37%. Now here's what this means in practice, and this is the part that eliminates the myth forever. If you earn $60,000 as a single filer, you do not pay 22% on the entire $60,000. You pay 10% on the first $11,600, 12% on the amount between $11,600 and $47,150, and 22% only on the remaining $12,850 above $47,150. Your marginal tax rate, the rate on your highest dollar of income, is 22%, but your effective tax rate, the actual percentage of your total income that goes to federal taxes, is significantly lower. In this example, approximately 15 to 16%. This is the number that actually matters, not your bracket, your effective rate. Now apply this to the raise scenario. If you currently earn $47,000 and your employer offers you a raise to $52,000, your marginal rate on that $5,000 increase is 22%. You pay 22% tax on those $5,000 additional dollars, which is $1,100 in additional federal tax. Your take-home pay from that $5,000 raise is $3,900 after federal tax. You are better off by $3,900. Not worse off, not equal, $3,900 richer. The raise always wins. The bracket never takes more than it gives. That is the fundamental truth of the marginal tax system. Now let us talk about the difference between gross income and taxable income. Because your bracket is not determined by what you earn, it is determined by what you earn after deductions. The federal government allows taxpayers to reduce their taxable income through deductions, expenses and contributions that are subtracted from gross income before calculating what you owe. The most universally applicable deduction is the standard deduction, For 2024, the standard deduction is $14,600 for single filers and $29,200 for married couples filing jointly. This means a single filer earning $60,000 does not pay taxes on $60,000. They pay taxes on $60,000 minus $14,600, which is $45,400 in taxable income. That moves them down from the 22% bracket entirely because their taxable income is now below the threshold where 22% begins. The standard deduction is available to every taxpayer without documentation or itemization. You simply claim it on your return and your taxable income drops accordingly. The alternative to the standard deduction is itemizing, adding up specific deductible expenses including mortgage interest, state and local taxes up to a $10,000 cap, charitable contributions, and certain medical expenses. Itemizing only makes sense if your total itemized deductions exceed the standard deduction. For most Americans, the standard deduction is larger and simpler. Beyond the standard deduction, there are several deductions and contributions that can meaningfully reduce your taxable income. And these are the ones that represent genuine tax strategy for ordinary earners. Contributing to a traditional 401k reduces your taxable income dollar for dollar. Every dollar you contribute to a traditional 401k is a dollar that is not counted as taxable income in the current year. If you contribute $23,000 to a traditional 401k in 2024, your taxable income drops by $23,000. At a 22% marginal rate, that is approximately $5,060 in federal taxes you do not pay. Contributing to a health savings account provides a triple tax advantage. Contributions are tax deductible. Growth inside the account is tax-free. And withdrawals for qualified medical expenses are tax-free. No other savings vehicle provides this combination. Student loan interest is deductible up to $2,500 per year for borrowers below certain income thresholds. Contributions to a traditional IRA may be deductible depending on your income and whether you have access to an employer retirement plan. These deductions are not loopholes. They are features of the tax code designed to encourage specific behaviors. Using them is not aggressive tax planning. It is basic financial literacy. Now let us talk about the difference between deductions and credits, because these are not the same thing, and the distinction matters enormously. A deduction reduces your taxable income. Its value depends on your marginal tax rate. A $1,000 deduction saves someone in the 22% bracket $220 in taxes. A credit reduces your tax bill directly, dollar for dollar. A $1,000 credit saves $1,000 in taxes regardless of your bracket. Credits are more valuable than deductions of the same dollar amount. The Earned Income Tax Credit, the Child Tax Credit, the Savers Credit, the American Opportunity Credit, the Lifetime Learning Credit. Many Americans leave these credits unclaimed simply because they are not aware of them. A thorough tax return can recover hundreds or even thousands of dollars you are legally entitled to. Now let us talk about the strategies that reduce your tax bill in ways that are accessible to any income level. Strategy number 1, maximize your pre-tax retirement contributions. Every dollar you contribute to a traditional 401k, a traditional IRA, or a health savings account reduces your taxable income in the current year. If your employer offers a 401k match, contribute at minimum enough to capture the full match before considering anything else. The match is an immediate 100% return that no tax strategy can match. Strategy number 2, understand when a Roth contribution makes sense versus a traditional contribution. Traditional contributions reduce your taxes now. Roth contributions reduce your taxes in retirement. The better choice depends on whether your current tax rate is higher or lower than your expected retirement tax rate. Many financial advisors recommend having both a traditional 401k and a Roth IRA to provide flexibility in retirement. Strategy number 3, time your income and deductions deliberately. If you have control over the timing of income and expect your income to be significantly different next year, consider timing that income to fall in the lower income year. Strategy number 4, track deductible business expenses if you have any self-employment income. Home office expenses, equipment, software subscriptions, professional development, business travel. These can all reduce taxable self-employment income. Strategy number 5, file your taxes accurately and on time, every single year. If you cannot pay what you owe, file anyway and work with the IRS on a payment plan. Filing on time, even if you cannot pay immediately, is always the right move. Let me bring this together with the clearest possible summary. The American federal income tax system taxes each portion of your income at the rate corresponding to that bracket, not your total income at your highest bracket rate. Your effective tax rate is always lower than your marginal rate. A raise never causes you to take home less money. Your after-tax income always increases when your gross income increases. Standard deductions, retirement contributions, HSA contributions, and applicable credits can meaningfully reduce what you owe. The most powerful tax reduction tool available to most Americans is maximizing pre-tax retirement contributions. Understanding your taxes is not optional financial knowledge. It is the foundation of every other financial decision you make. Because every dollar you keep through intelligent tax management is a dollar available for the investing, saving, and debt elimination that this series has been building toward from the beginning. Subscribe to Fin Wealthwise because next week I am showing you something that will genuinely shock you. The exact dollar cost of a poor credit score on a mortgage, a car loan, and a credit card. The numbers are larger than almost anyone expects. I am Finn. This is Fin Wealthwise, and I will see you in the next one.